Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app.
This podcast is proudly brought to you by Challenger. At Challenger, we want to help you ensure that your retiree clients can meet their retirement needs today and tomorrow. To access thought leadership, insights, and tips on retirement planning for your clients, head on over to challenger.com.au/XY.
Welcome back to the XY Advisor Podcast. I'm Fraser Jack, and we are wrapping up today the series on the changing landscape of retirement. I am joined by somebody who probably needs no introduction when it comes to conversations around superannuation, Jeremy Cooper. Welcome.
Morning, Fraser.
Now, for those XY listeners who may not be familiar with you, even though I've said you need no introduction, do you want to give us a quick overview of you and your history in what is probably a fairly legendary history around the Australian superannuation system?
Sure, Fraser. I'll be as quick as I can be on this one. So, interestingly, I started my career as a lawyer. So I can say that I spent 2 decades as an advisor, advising about different sorts of things, but using the same tools, I suppose. And then I sought something more interesting to do, I think, and I ended up being the deputy chairman of ASIC for 5 years. That was in the mid 2000s. I spent a lot of time working on what I call retail financial advice issues. And when my statutory term ended, the then Rudd government asked me to chair a sort of holistic and first-time review of the superannuation system, concentrating specifically on things like efficiency and governance and structure. And I had the privilege of spending 12 months doing that. That report was tabled in mid-2010. And then over the last 10 years, I've been working in a research and thought leadership and policy role at Challenger. And I guess there are my credentials for having this chat with you.
Yeah, fantastic. I think credential-wise, the changing landscape of retirement certainly started with things like the Cooper Review back in 2015. So the changing started a while ago. Obviously, everyone's going through a lot of change, and so we've got plenty to chat about. And of course, this is the last podcast in the series. So we're going to sort of do a bit of a recap of some of the thought leadership that came out of the series itself. All sorts of different things came out of it, which has been fantastic. And so we can talk about all those sorts of things. And we can add in all your opinions, of course, as well, around what you think sort of some of the fears and some ideas around what sort of concerns retirees might have as they move through this period of their lives. So thank you for joining me today.
Pleasure.
Now let's kick it off with let's start with a bit of an overview. Let's have a conversation around around what your thoughts were around the series, around some of the or all of the podcasts, essentially from an overall point of view.
Yeah, thanks, Fraser. So blending the 9 podcasts all together, I was struck by just how human each of the speakers was. These were people who really wanted to be doing what they were doing. They weren't reluctantly helping people. It was a very non-technical discussion in a lot of ways, even though the ideas behind what some of the people were saying on the podcast were quite technically rich. They had a way of saying it in a simple and pretty captivating sort of a way. And we sort of, people talk a lot in the advice space about the soft skills, but a lot of the speakers were talking about things like trust and reassurance and educating their clients, breaking things down into simple chunks, using visual aids in some cases, diagrams, videos. One person, I think it was Nicola, described herself as a confidant. That really resonated. Building trust and having people able to rely on what you're telling them.
Yeah, couldn't agree more. And I think advisors and planners around the country have always sort of been very good at that, having those conversations. And I sort of think about it as a translator. They're sort of translating this jargon and corporate speak, which we've all become accustomed to, and then turning it around and saying, well, actually, in the eyes or the ears or the feelings and thoughts of an end client, it's a very different language that they need to then speak. So let's go through some of the series. Let's talk about some of the conversations, perhaps from maybe the first episode regarding with Martin. Some of the things that really struck me with him is around the budgeting and cash flow of retirees, around that spending conversation, and again, obviously, bringing in the human element. And one of the things that I noticed he mentioned was the concept of the pension being the silver lining.
Yes. Yeah, look, Martin was terrific because, some of the work we do at Challenger, we try and distill things, just like these people do, try and distill things down into very simple ideas. And over the years, one of the ones that we use to talk about retirement is we used to say that cash flow is king. And so in a world where we save up and what is king there is really high investment returns, taking the least amount of risk at the lowest cost. As the person who sort of thought up the My Super idea, that's what My Super does. It just whirs away in the background, and it doesn't. The only cash flows that are involved are ones being put in by your employer, typically. When it comes to retirement, that kind of flips on its head. And what's actually important is that you get the spending money, if you like, because that's what retirement's about. You've deferred consumption that you could otherwise have enjoyed in your working life, and now you're getting it in retirement. And we heard this over and over again in the discussions. We heard people saying, I think it was Noel saying that people, are really reluctant to spend their capital, and the job of the advisor is to give them the confidence to do that. It's partly psychological, it's partly giving them the products that help. And yes, the role of the pension is if you're entitled to age pension, that's your fortnightly paycheck from the government. And I often get people to think about the age pension and say, well, that is, in a sense, the archetypal retirement income product. You know exactly what's coming. It's unquestionably income. It's for spending. It's not for putting in the bank. There are, as I think it was Noel again, who sort of said, well, there are trade-offs with that. You can't pull an age pension. You can't pull a lump sum out of the age pension. It does a specific thing. But it's where you should be starting. It gives you that peace of mind, that security that other sorts of retirement income products don't give you.
Yeah, now we talked about the mindset of spending, and again, there was a few people that talked about this, but that mindset of spending your savings when you have spent your entire life not spending it. The whole purpose was to continue to force feed the savings, and then then to tip it upside down and say it's not savings anymore. It was a really hard mindset for the end consumer.
I call it as if we need more battlegrounds in the super space, but this resistance to consume capital is the real sort of battleground at the moment, and I'm sure it's an area where advisors are spending a lot of their time, and it's partly because of the low rate environment, where even as recently as just going into the GFC, which I suppose is getting a few years back now, but you could buy a 10-year Commonwealth government bond that yielded you nearly 6%. And so what I call a yield-based retirement, where you don't consume your capital, was quite a realistic thing for pre-retirees and retirees to be thinking about. And, for the foreseeable future, that simply is not the case. And so when people talk about and think about retirement income, that is not accounting income or a yield. It obviously includes that, but it also includes a steady and safe rate of consumption of your capital. Otherwise, you're simply not going to, for most people, you're simply not going to be able to sort of have the standard of living that you're really entitled to. And in a world where all your kids have got their own super, the imperative to leave sort of large slabs of your own retirement savings to the next generation, the drivers just should no longer really be there.
Yeah, that's a very interesting point, isn't it? The fact that a lot of the retirees now, their kids will have almost had a full working life of super guarantee to
Yeah.
look after them when they get there. So now I wanted to talk a little bit about also when I think about what Gail said in the second episode, a lot of one of the things that really struck me when I spoke to her was just the level of fear that's around some people approaching this stage of life, especially if they're single. And she mentioned a stat that stuck with me around, single women over 55 being at highest risk of homelessness. And just that word homelessness approaching that time of your life struck a real chord.
Yes. Look, again, I think Gail was very strong on the human side of things, but the status, the marital status of retirees was another one that came up a few times, and there are some very interesting statistics. But I think one of the speakers said, well, look, there are sort of three scenarios. You're either just a couple or you're single. Of course, you could start as a couple and become single. And then there's a third species, if you like, or situation where you're a couple, but in fact, one of them is, often quite unpredictably, a carer. And all of the different sort of combinations of those things. And they can have some quite significant financial impacts, obviously, particularly where the outcome is unexpected. And in some recent work we did with National Seniors Australia, we did a fascinating survey of over 60s, and we asked them specifically about their marital status. And we found that 80% of these men, so 60 and above, all the way up to quite older ages, 80% of them said they were partnered. Only 44% of women in that age group said they were partnered. Now, initially we were turning these answers upside down and scratching our heads and thinking, well, hang on, what's going on here? But what happens is, of course, you've got just a number of things going on with those numbers. One, on average, women outlive men by about 3 years. So they can be in a perfectly stable marital situation, but the woman on average is just going to outlast the male. So there are a lot more much older and single women in a population cohort like that. But perhaps more interestingly, where marriages either cease because of a death or a divorce, and the divorces definitely happen in retirement, men will almost predominantly anyway, will almost certainly remarry, typically to a younger wife, and the women will not. And so this has got a pretty strong financial theme running on it, because of course we know from the signal that the age pension gives off, the single rate age pension is relatively higher than the couple rate, because it's actually more expensive to live alone. And so in planning and thinking about this, particularly for women, the predicament of them, spending a long time living alone in retirement, it's got a whole lot of social, psychological, but particularly financial implications.
Yeah, incredible. Now, speaking of stats, actually, we were lucky enough to pick up some stats from Core Data throughout the series, and some very, very interesting stats in there. One of the things that struck me, of course, was the concept of control and controlling things as they happen. That was the theme, obviously, throughout the whole series, trying to get control before things got out of control, if you like. And the decision-making process, obviously, is a lot easier to make if you're planning versus, reacting to decisions. But one of the things that I was quite astounded about was the fact that, I think Jason mentioned that there was only 7% of retirement was retirees retired when they planned to retire.
That was quite remarkable, and the implication there was that it sort of, sadly, often they never sort of, from that, I suppose, shock, they never quite recovered on the satisfaction score after that. And I think also particularly striking for me was this similar statistic for people who were relatively recently divorced and then found themselves in an involuntary retirement situation as well. There was some, very strong correlations with what we would expect between people who were renting in retirement versus people who had a home but yet still mortgaged. And then the most satisfied were, not surprisingly, people who had their own home with with no mortgage. But yeah, very interesting piece of work there. And of course, it's understandable that people want control and uncertainty sort of moving into retirement. But, that's a very difficult thing to actually achieve in a world where you've, receiving a regular wage or salary, into the situation where you're effectively living off capital for the first time. We live in a very fast-moving world. Things are going to keep changing. Unfortunately, a lot of retirees bemoan the fact that, the age pension rules keep changing, superannuation keeps changing, tax keeps changing, and so on. And unfortunately, I can't look anyone in the eye and say, well, there's going to be a world soon where that's not going to happen. And part of the reason why it keeps happening is the things underneath those rules keep changing. In other words, our demographics are shifting. A whole lot of things keep changing, and it's very difficult. And this is where these advisors were doing such a good job trying to give the reassurance, trying to provide the information in a simple way, but that control motive is very strong.
Yeah, some certainly interesting conversations around that control piece, because I think it's absolutely a huge piece. I think you mentioned something like six out of 10 people, or almost 6 out of 10 people, feel like they're forced to retire at that time, and so. And you also mentioned obviously community, and a lot of people talked about the community being a big part. So income, obviously regular income, community, and control. Now, one of the things that we sort of touch on quite a number of times is, and obviously Jason was talking about this too, was this idea of collecting qualitative data. We're very good, aren't we, as an industry, at understanding the numbers when it comes to returns or stats around population, but we're probably not that great at collecting that happiness index type conversations around, are people satisfied? Are they stressed? Are they fearful? And if so, on a scale of 1 to 10, whereabouts is that? I think the medical profession are quite good at it when it comes to how much pain are you in. But that's probably one thing that we could, as a profession, do a better job as.
I think you're right. And one of the most interesting. Now, the reason that this broader topic of financing retirement and the various elements of that is so interesting is that it brings together just so many different skill sets, from psychologist to statistician to you get into the heavy duty. Fortunately, we didn't hear too much of the heavy duty stuff, but the whole sort of pension finance, projecting out into the future with unknown life expectancies and all those sorts of interesting things. But it does bring together a huge range of human disciplines in this space. And I think that's what makes it so interesting for me anyway.
Yep, absolutely. Now, we probably move on to some of the conversations we had with Nicola. Now, one of the things that struck me when I had a conversation with her was really around the conversation around the transition periods and the time it takes for people to really transition to one stage of life to a different stage of life. And we can certainly talk about stages later on as well. But just I resonated with what she said. She talked about that process often being similar to a grieving process that we go through. And that really brought that psychology, as you mentioned, piece to me to say, well, you know what? I think that you could be right. There could be a process that we need to understand that people go through.
Yes, I agree. And I think we probably don't, let's face it. I suppose one of the ideas underlying this whole topic of the changing landscape of retirement is that, it was only, in a sense, 2011, I think, was the date on which the post-war baby boom generation really started moving into retirement with, on average, far more wealth than any other. Superannuation was, or a lot of people say superannuation is immature. I think they're just not looking at the numbers when they say that. But, households now are retiring with, the rest of the world just looks at Australia and says, well, how did they do that? So a lot of this is very new. Even since the early 2000s, the average life expectancy of Australians has shot up in the last 20 years by nearly a decade. It's about 9 years. So we just the speed with which this is happening, it is pretty new. People are going to be a long time in retirement. We still haven't conquered some of the cognitive decline, dementia problems. So advisors will know this, but if you're sitting in front of a person who's 65, that's about a 10% likelihood that they're already suffering from some form of dementia. And then when they get into their mid-80s, that's about a 30% likelihood. And we haven't really cracked that walnut yet. So that's another sort of dimension, if I can put it that way, to this relatively new world where substantial numbers of our population surviving to the retirement age, which of course is now effectively 66, and living a very, very long time. And I think it was Noel who reminded us that people underestimate how long they're actually going to live in retirement. We've done some work again with national seniors. If you're in your early 50s, you're massively underestimating that because you haven't really thought that much about it. And as you age, once you get into your mid-70s, the sort of light bulb actually comes on, and people are actually pretty good statisticians around how long they're going to live, perhaps because they've seen colleagues and older friends and so on. They've got some sort of better handle on just how long people are going to live. And for today's 66-year-olds, that's on average 87 for men and 90 for women. And of course, that's only the peak of the bell curve. So it's a whole new ball game that we're dealing with, and there are a lot of things that we don't yet know.
Absolutely, it's got to be a challenge for Challenger in that respect, because obviously that, as you mentioned, the superannuation system, is well revered around the world. An overnight success, 30 years in the making. If you like, it's been it's not exactly we've been building on this for a long period of time to make it what it is. But I'm interested in what you said around the life expectancy or the longevity piece there for people, because obviously if you're coming into retirement and there is more money there and there is more lifestyle, there is more information and knowledge about health factors and all the other things that can extend your life essentially, because you're going in healthier and wealthier. How does that work that's got to be a challenge for Challenger.
Well, actually, yes, and it's it is a very ensuring pool of lives is what we do for longevity risk. In other words, we're pooling lives together and adding shareholder capital effectively to be able to protect people who live considerably longer than average. But in a sense, we benefit enormously from the law of large numbers, if I can put it that way. So if we've got tens of thousands of lives in our pool, with the right actual additional buffering and supervision from APRA and all the capital and so on, in a sense, I don't want to sort of underplay this, but in a sense we have the easy part because the law of averages, so there'll be people in our pool who die younger than average. There'll be a lot of people sort of dotted around the average, and then there'll be the long livers. But on average, because we've got so many lives there, that law will see the actual ultimate financial outcome come pretty close to the average. And of course, we're watching this all the time. When you flip out of our longevity pool to the ordinary people in the street, or for example, the two people sitting opposite an advisor in their office, their life expectancies, they can be part of our pool, but if they're not, the randomness or the variability, if you like, of their lives against the average is far more significant than people actually understand. These life expectancies are actually quite misleading. They're not misleading for us because with the tens of thousands of lives, we can sort of go, aha, look, we're at the average. Whereas if you're just one or two people, your lives, it's about as sort of variable as stock market returns. We've actually done some work which shows the remarkable correlation. So they, one standard deviation of life expectancies would see, let's make it easy. Let's have the woman sitting there and the 66-year-old woman sitting there in the advisor's office. Her life expectancy is anywhere, so in 2/3 of cases, she'll die somewhere between 82 and 98, but not with any degree of certainty at the average. In fact, the likelihood of her dying at 90, you wouldn't believe this, but it's less than 1 in 20. Yes. So individually, life expectancy is quite a random and volatile thing. In a pool, it's not.
Yeah, I think that was definitely one of the messages that came out of it too. It's, you sort of sit down and say, according to the law of averages, you are here, but there is a 95% chance that you're not average. So, very good. So, as you mentioned Noel a few times, obviously Noel was, a bit of a gem when it comes to the all things superannuation. He literally wrote the book on it, and so he was able to pass on quite a few gold nuggets, or we call gems, during his episode.
He certainly did, and one of the really terrific ones was trying to reinforce this point of you can't take your money with you. This spending thing, and he wrapped it up by saying, well, if you don't fly first class, your kids will. I thought that was fantastic.
Yeah, he's definitely a good straight shooter, doesn't he, when it comes to all things around superannuation, and he also knows his stuff when it comes to all the different factors that around happiness and retirement and people being satisfied and
he was very strong on that. Yeah, it was basically your sense of purpose and your the things that are controllable. So your group of friends, how much exercise you do, and your diet. Well, that's pretty catchy as well. He was absolutely right. The other one I really liked from Noel was he said, look, thinking about your your financial assets in retirement, think about it as he might not have used these exact words, but this is how it sounded to me. Think about a pie. It's got 3 slices in it. One of them is the age pension. That comes from the government, gives you regular payments. It's, effectively AAA rated. It's there. Then you got your private savings, and what he meant there was your superannuation, your cash that you might have in the bank or what have you. That's accessible and liquid, but it's also can be volatile. And then he talked about a lifetime pension, and what he really meant there was effectively that's your annuity slice, if you like. And he didn't use this language, but what you'd effectively be doing there is you're buying a little bit more of the age pension, if you like, this secure regular money. And every one of those pieces of pie has a trade-off. It's the one slice doesn't do everything, but in combination, that's how you should be thinking about your retirement. I thought that was another gem.
Yeah, it certainly was. Very, very much looking around the well-rounded, eggs and baskets and all those types of things around saying, well, there's 3 main levers and we can set these levers so that to give you the best, way of living and peace of mind and all those sorts of things, because it's not, it's not just about the numbers. It's very much around the emotion and the, people going through that process. Which brings us to a conversation I had with Phil. Really, I guess we kicked this one off around the conversation around the baby bust, which is a bit of commentary which has been out there for a while, I guess, and around the conversation of these baby boomers coming through and what's that going to do to the actual system as they move through.
Yeah, it was interesting that because of the beauty of these podcasts is that I certainly didn't have anything to do with who was going to speak and what they were going to say. And as I was listening to Phil and talking about Bernard Salt and the baby bust paper, I thought, oh, gosh, I know that paper. We actually worked with ASFA at its most recent annual conference just in early February. I interviewed Bernard about this paper, and it's basically pointing out, again, I'm talking a little bit around what I've been talking about, this sort of new phase that we're in, the emerging retirement income space. And the baby bust concept is, in his research, he's saying that in 2026, we're going to have sort of what he calls peak boomer. So in other words, this wave that started in 2011 that I was talking about sort of reaches its peak in 2026. And the point is that all of those sort of, in his inimitable style, he was talking about the sort of wave of people who got free tertiary education, those were the sort of Whitlam settings, if you like. They contribute to the workforce and then they leave it. And so what happens, do they cling on to their jobs, or do the younger people sort of move them aside? And what happens to the economy when you've got increasingly fewer workers and more retirees? The economists talk about that as the dependency ratio. And so there are a lot of interesting things that Phil spoke about off the back of that. But I think one of the most interesting things for me anyway, in what Phil was saying, was this concept of what he called values-based advice. And not so much, it was a sort of species of goals-based, the way I understood it anyway, but aligning with the the values that the client has and trying to sort of fulfill those rather than just constantly talking about money. And in fact, I think it was Phil who said, look, it's not about money, it's not about fees, it's not about returns or adequacy. These are all the sort of icons, if you like, of people who talk about this stuff. It's really about taking stress off the client, advocating for them, not just retaining clients, actually being an advocate for them. And, through those mechanisms, helping them fulfill their values, which I just thought was a really nice way of talking about this.
Yeah, absolutely. That's definitely the pathway to happiness, making sure that you're filling those emotional values. And the other thing I noticed too with this conversation is around the emotional state. We sort of mentioned before around fear and stress and anxiety and worry and those sorts of things. And then providing this, positive emotional state and a state of, being happy and content and those sorts of things helps make better rational decisions. And quite often it's very difficult from the planner's point of view to present a rational decision to be made to a person who's in a state where when they're not physically or mentally capable of making those rational decisions because they are stressed or anxious or upset or worried.
Yes. Yeah, I think that's right. I think also the most worried people are the people the sociologists and so on call it an anticipatory worry. So people who aren't yet in retirement, they started thinking about it and it really, really scares them. And as they move towards retirement, and then, even I think it was, again, one of our podcasters said that they thought it took a good 18 months or perhaps more for people to actually adjust into the circumstances of retirement. And you think about that, it makes sense. If you've worked all your life, there's a whole routine that you go through. Accompanying expenditures, the more expensive lunch that you have to buy in the city, all the transport, they all just disappear and things settle down to the norm of what it's like to be in retirement. And we, again, working with the national seniors, people tend to be quite okay with adjusting to whatever their new circumstances are. And these circumstances can, in some cases, be quite different from what was envisaged or the lifestyle that was enjoyed while working, but they seem to be able to, once they're in that situation, they tend to find that it maybe wasn't as bad as they were fearing.
Yeah, absolutely. Again, it comes back to that transition process, and perhaps whether it's similar to a grieving process or not could be for a lot of people, but it's definitely an emotional process that to go through. And then you're absolutely right. The conversation did tend to be once people have gone, okay, it's a bit like riding a bike. I'm used to it now. It's actually okay. I don't know what I was worried about, where that fear and anxiety was coming from. So as we move through the conversations, we sort of talked about a lot of around aged care, around a lot of retirees having both experience with aged care, not just for themselves, but for their parents.
Yeah, well, I think we find a challenge. We have products that seek to help in the aged care situation, and often not necessarily our clients, but there's considerable stakeholders nonetheless in some of the discussions and decisions are indeed the generation of effectively the children of the retirees who may be in their let's say their 50s or perhaps their 60s are intimately involved in sort of helping with some of those decisions. Often made more or less at the last minute. And I think Rachel spent a bit of time explaining how you have retirees who resist, defer decisions, or even sort of actively declare war on the idea of going. She used words that were reasonably similar to that. The idea of going into residential care, but she explained that, of course, everybody thinks it's just residential care, but there's a whole panoply of different choices that can be made, and that's really where the advice value proposition comes in. Yes, the finances are, again, it's like getting the age pension all over again, quite complicated. But Rachel was explaining, hey, that's the advice piece is actually all about what you can choose, what you get or don't get. And so there's a whole world of making things better so long as you're getting the right kind of advice. And I thought that was extremely valuable material.
Yeah, Rachel has a very good way of explaining a lot of that and putting people's mind at ease a little bit too with what's available. One of the things Rachel also mentioned that I was intrigued about was and we sort of talked about this with the baby bus conversation, is around aged care and the fact that I think she mentioned something like it's going from 1.3 million beds to 3.5 million beds in 2050 or thereabouts. So that's a huge the bubble, if you like, coming through into aged care and what's that going to do for the aged care sector. And obviously a little bit of that was addressed at the Aged Care Royal Commission, but it doesn't sound like there's been too many outcomes from that.
No, Rachel painted a pretty challenging kind of story about where, I think she was prefacing that some fairly major changes were going to have to happen in this space. She used one example of well, the one interesting point she made was that indeed the aged care workforce itself, so the people who service aged care facilities are ageing. So not only is there pressure on things as they are now, but as time marches on, where are all those workers going to come from? And I think she was presaging a world where things are going to have to centralise themselves in hubs. At one point, I think she was talking about, well, think about it, there just aren't enough nurses in Australia to be hopping in cars and driving from home to home in a world where we think, oh, it's easy, we'll just have everybody, in home care. Well, okay, that sort of decentralises things, but it comes at an enormous service cost of getting to all those different locations. So I think she was optimistic in the sense that she could see the sort of changes that she thought needed to be made, but they involve some fairly dramatic shifts from what we're doing at the moment.
Yeah, absolutely. That includes, developers building these types of facilities and hubs and
exactly
and all sorts of things. So yeah, that was really interesting.
And who's going to pay for it all?
Exactly, and just the sheer mindset as well too that the baby boomers don't want to do things the way that their parents did them. And I guess that works. For every single other generation. I don't think my kids want to do things the way I do it. That's for sure. Now, the next person we heard from was Sheena regarding a lot of the Centrelink side of things, and obviously that's an interesting process for a lot of people. There's often can be a lot of fear or pain points around dealing with Centrelink.
Yeah, this came through a lot, particularly with Sheena, and even just the idea of these, I suppose, intermediations, or you might call them concierge services, where it's become a viable business to effectively help people access a government agency like Centrelink. And Sheena was another person who spoke with great passion about what she was doing, and that sounded great. And obviously adding a lot of value. And indeed, Challenger itself finds this to be a thing as well. So we have, for a reasonably short period of time, got a special arrangement with a similar, I'm assuming, similar outfit to AdviceLink that Sheena's got. They're called Retirement Essentials. And Challenger's offering advisors, as I said, for a limited period. And there's a microsite that we've set up where people can go and have a look. We're offering a free access to Retirement Essentials to give advisors the experience of getting this very sort of assistance with guiding people through the perils of Centrelink, and just giving clients a sort of an assessment of where they might be in relation to the age pension. And we again heard from Sheena about people's just reluctance to, that there's still with some retirees a stigma or just a reluctance. They don't think they're entitled to it, and so they don't access the age pension. Indeed, even in our research, we look at age pension access by age, because a lot of people talk about the age pension just as a great big blob. And what I mean by that is they talk about everybody over 65 accesses the pension on average of X. And we said, well, that's not a very informative number. Let's look by year groups. And what we see is that very new retirees, so if we were looking at for effectively 66 to 70, there's actually a very low rate of access to the age pension. Now, this could be driven by a number of different things: longer participation in the workforce, lack of eligibility because of high super balances. But we get the sense also there's this kind of lag or reluctance of, oh, geez, I don't have to. Well, there's some people who absolutely need to front up the Centrelink on day one to get their age pension because they simply wouldn't be able to survive. But there's a middle group who seem to take a bit of time, and services like this have come into that space to just take the pain away effectively.
Yeah, I think the services that you're offering are fantastic. Obviously, there's reasons why people don't approach them or don't really feel like it at the time, and obviously, time is one of those things. The amount of time it takes to spend, and they'd rather be doing other things. But also the fear of rejection or fear of being told no, and the just the misunderstanding, I guess, of a lot of the concepts. But I think a lot of the time, again, advisors are very good at being the translator when it comes to financial services products. And I think we kind of need almost that translation service when we're talking about Centrelink items. So there's that. But I also think she hit the nail on the head when it comes to the people in Centrelink are just humans doing their best, doing their job, and quite often they're put in a situation where they don't quite always know what's going on, and they're dumped in a situation where they have to help people, and so sometimes it's just the fact that a training problem.
Oh yes, yeah, it's a hugely technical. This is why these specialists, I suppose, have developed it. That it is it's a specialist niche, particularly with your dual means tests and all that other kind of complicated sort of stuff. So yeah, it's not easy.
Yep, fantastic. Now we move on through the series, getting towards the end now. We spoke to Richard, and I really love what he talked about with the different stages of retirement and how he explained that to his clients.
Oh yeah, no, it was great. You have to like the teenagers and the comfy shoes and the comfy chair. And I thought the teenagers was particularly resonated. People who've been locked in the workforce, bringing up kids, all of a sudden they've got a bit of free time and a bit of their own money, and you just got to sort of let the reel out a little bit and let them do their thing. So I thought that was really interesting and quite useful. And again, I think it was Richard who was talking about how long it takes to adjust into retirement, but also he was a big one on what he called the sort of surety of income, the security of people's regular needs. And I think he had a nice little sort of rule of thumb where he said that for clients who needed say $50,000 a year, they get 80% of that from the age pension and an annuity, and then effectively he's assuming that they've got additional liquid savings in the form of super, which in a good year is going to top that up. In a lean year, maybe not. And he called it their pay packet. And this is a challenge that we just always talk about, in retirement. Where's your retirement paycheck coming from? Working out, what you actually need as opposed to what you want. And again, in one of the podcasts, there was, it might have even been in Jason's, but I'm not 100% sure, that a very high number, a surprisingly high number of people surveyed or in this particular client base could actually make the distinction between expenditure that was needs oriented as opposed to wants oriented. And the idea is, of course, when you have a year that's not so great, you can reduce expenditure on the wants. And indeed, this comes back to, again, in one of the podcasts, we heard about the sort of core function of the advice was really doing an annual cash flow forecast, which is kind of, okay, well, another year's passed. This is where we started out. This is what happened. And, now we're going to talk about what it looks like going forward. And that would largely be a mixture of the investment return experience, I suppose, for the portfolio. How much were you spending over or under the budget? But interestingly also, and this came out in a couple of podcasts, the relevance of understanding things that might have changed from a health perspective with the clients. So, there's no point sort of robotically spitting out, average statistics about things if one of your clients has unfortunately just received a cancer diagnosis. So this is a sort of swing factor and very much what the value that can be added, I suppose, in the annual catch up is really just to understand, how things are going from the health perspective.
Yeah, absolutely. Yeah, there's definitely a lot of aspects of that. Cash flows, funnily enough, cash flow comes back to being king again, doesn't it? Surety of income.
It sure does. Yep.
Surety of income, providing that emotional state of being actually I'm okay. I know I've got income coming in. I know I can pay my bills. But yeah, I did really enjoy Richard describing that teenage years. As you mentioned, the freedom word. Getting some freedom from the daily grind, or from kids leaving home or whatever it might be. Very similar to the freedom of getting your driver's license or leaving home for the first time. So I thought that was absolute classic, and I think there was some conversation that came out around those 3 life stages being able or less able and dependent as terms, but I really did enjoy Richard's interpretation of that. Now, obviously, that's sort of the series of the people we interviewed, but there's obviously a few other things when I think about, or you and I have spoken about the changing landscape of retirement that we sort of didn't cover so much in these episodes, but things, and we've sort of touched on intergenerational tensions, but technology is one that I've always, enjoyed. And we sort of did talk a little bit about technology in the series and embracing technology, and debunking the idea that retirees don't want technology.
Technology came through in a lot of the podcasts in a positive way. It was either that they were using, they weren't making a big deal out of it, but they were clearly using tools in helping their clients, and there were opinions expressed about the typical retirees of they've got kids overseas. I'm in that situation myself, and so that in a sense creates a need and a use for technology. So I think the themes were positive, but if you project out, if we're talking about how this might continue to change, there's no doubt that we are going through globally a period of a very rapid technological change. And the concern and the issue for retirees is that once you disconnect from a workplace, you are effectively your own IT manager. And indeed, we talked earlier about the next generation, the role that adult kids can play in this. I think my parents are in their 80s, and I've done things like buy mum an iPad to try and keep her up with the, but she can now no longer use that, and so the fear is that as you get older, it just becomes more and more difficult. Imagine if you'd just been a little bit too old to catch on to the smartphone world, if you like. And so, particularly during COVID, if you weren't carrying a smartphone, it's very difficult to keep up. And so that's a bit of a metaphor, I suppose, for the challenge that lies ahead for a lot of retirees.
Yeah, fantastic. Now, we also had some conversations around, global risks and, all sorts of things from climate change through to, obviously pandemics, and how that's affecting, retirement.
Yeah, look, I don't want to make too much of this, but I think, again, for people who have been in retirement for a while, perhaps the prominence of climate change issues in our society is going to become more pronounced than it is now. And again, for people who just sort of haven't really been on board with that, they're going to find, I think, that even investment products will be sort of captioned, is this a climate change for, very rapidly we're going to move into a world where, for those who are participating in workplaces and are in the, still in the working age population, are going to find a significant amount of change. But for people who are sitting at home, they're going to find it quite confronting just how quickly we're going to move into a world where climate change and climate change investment products is really what I'm talking about, are going to become a real thing.
Yeah, it's certainly I don't want to call it a trend because it's a change that's taking place, and a lot of people taking that very seriously, especially when it comes to the end consumer having preferences around what they want or how they want their money invested based on their beliefs and their values.
Yeah.
Just quickly before we go, I wouldn't mind touching on the inequality, the gender pay gap, the gender superannuation gap. conversations, because that's not really something we spend a lot of time talking about within the series, but it's certainly something that is part of the changing landscape.
Yeah, I think the research we do shows that the gender gap is narrowing. There's an interesting trend where women who can do this in their 50s tend to be topping up a little bit on super. I know with the recent cabinet reshuffle that Jane Hume has assumed responsibility for, I think it's called women's security, financial security. So there are a lot of people looking at ways of closing the gender gap. I guess the gender gap in super or in retirement savings is really just a derivative of the employment gender gap. It's a secondary symptom, if you like. But for the reasons I spoke about before, you may go into retirement as a financially well-off household. Things can happen in retirement, and it's often the female who finds herself living longer and living longer alone, and it's that tail end piece. And for women who are already living alone pre-retirement, it's even more burdensome because of the feature I spoke about before. It's like buying a house by yourself. It's simply more. You don't get the sort of economies of scale, if you like, of having two people contributing.
Yep. No, that's exactly right. So that's there's still some stuff to work on there. Now, the other thing I just wanted to quickly touch on was the conversation around stop working and retiring being the line in the sand. But as we know, there is a lot of people that then cut down to a few days a week, or go part time, or spend some time consulting, or spend quite a bit of time working into their retirement years. Do you see that becoming more, or how do you see that as a trend? Is that becoming more and more? Or?
Again, the data takes a little bit of a while to become visible, but right now, certainly in this decade, the age at which particularly well-educated and reasonably well off, it's a little bit different if you have a blue-collar job, but people are going to be spending, remaining in the workforce to much older ages because they want to, because they can, and COVID has really given this a real fillip, so that older people in the 60+ age group, so people of my age have experienced again, it's been involuntary through COVID, that in fact they can perform their roles either entirely from home or partly from home and partly at work. So they've already had a sort of a 12-month pre-taste of what it may look like, not to retire, but to move into a sort of interim period where they may be fully employed, but doing it in a sort of way that feels a little bit like pre-retirement. So that's been in a sense, a remarkable positive that's helped. One of the speakers was talking about the idea of taking as much annual leave as you can before retirement to sort of get in the field. Well, we've had a turbocharged version of that by the end of COVID. So there isn't that sort of cliff edge where on a Friday you sort of get your gold watch and hand your keys back in on the Monday you're in retirement. COVID has actually sort of sliced through that.
Yep. Now, thank you very much for joining me and having this conversation today. If we chunk back out to the big picture, looking forward into the future, do you see? Obviously, change is going to happen. There's going to be, there's a whole lot more changes coming down the track. We're just not sure what they are. What are your predictions on those? What are the things that are coming sooner than later, or what do you think we need to work on first for the entire system?
Well, it seems as if the debate about the SG going up to 12% is, I think there are some well-informed leaks that that's going to continue on its path up to 12%. I've always been relatively ambivalent about that, largely because you've got to be under 50 to actually feel the because of and again I'll attribute this to Noel, but Noel reminded us over and over again about the impact of compounding and having money that's been sitting in the system for a long time. That's where you get the kicker, and the reason why super is working so well now is that we went up to 9% in 2002. Okay, nearly 20 years ago. So yes, overall going to 12% is most likely a good thing on balance. But if you're 50 or over, you'll really only see an incremental change in the amount that you retire with. Younger people, yes, it'll make considerable difference. So we can kind of push that away as being a big deal. I think the big change, if we're going to be in this low rate environment as long as it looks like we're going to be, and people are certainly not going to be living shorter lives, they're going to be living longer ones. It's this giving people the confidence to spend their retirement savings, protecting their longevity risk. And longevity risk is not something that you really spend a lot of time talking to clients about. It's not a topic they really grasp. They don't necessarily want to be thinking about their own lifespan and their own death and so on. So you can kind of put longevity risk under the bonnet, but what you're really doing in adding a longevity risk product to the mix is you're giving them the confidence to spend now. And this is what the government is working on in relation to a thing they call the Retirement Income Covenant, which creates a new duty on trustees of large funds to have a strategy that actually does exactly that, gives people the confidence to spend. So that's going to be the big change, because we heard from a lot of the speakers that people are effectively self-insuring. They're creating their own buffer of capital, which is what a life insurance is. That's what Challenger does. We get shareholder capital to buffer and make sure that your annuity payments can be made. And what we have at the moment all around Australia is retirees doing that themselves. And as a result, they don't have the confidence to spend that, and they're passing the money on to the next generation. So that's really the big change that's coming.
Yeah, fantastic. And you're absolutely right. The confidence in spending, that's certainly what the government and the economy is after at the moment, as at the current state of where we're up to. Jeremy, thank you so much for chatting with me today. Now, what are the next steps from here with regards to? I think there's a thought piece going to be created out of this series, and how can people find or upload?
Yeah, we're looking forward to writing up a piece of work, a piece of thought leadership, if you like, summarising and picking out all the interesting points from the podcasts. And what we're wanting listeners to do is to register to get one of those, and you can do that by going to challenger.com.au/XY, nice and simple URL. And when the thought piece is done, it'll turn up in your email inbox.
Fantastic. Thank you. And please pass on our thanks to everybody at Challenger for sponsoring this series. It's been fantastic to have you on board. Really appreciate it.
Oh, it's been a great pleasure. Thanks, Fraser.
Well, there you have it. And that concludes our series sponsored by Challenger regarding the changing landscape of retirement. I'm Fraser Jack, and it's that time of the week where we do a couple of shout outs, and I'm joined by Emily. Welcome, Emily.
Hey, Fraser. How you doing?
Very, very good. Thank you. Very good. Now, who are we shouting out to today?
All right. Today we are going to give a shout out to Hayley Knight. She jumped on for an XY Plus web event recently and totally crushed it. She shared some phenomenal strategies and tips. Well, actually, we went through the top 4 mistakes that advisors make when looking for an outsourced paraplanning relationship. And to counteract that, she gave us a bunch of tips to help advisors find a productive and profitable relationship with an outsourced paraplanner. So lots of great takeaways in there. Very generous with what she shared. So it was just a really, really good way to level up and understand how to find a great outsourced paraplanner. So thank you, Hayley.